When you start investing, you are hoping that the companies you invest in grow. And in a best case scenario, those companies grow to be the biggest companies in the world. That's the ideal outcome. But what about those companies that have already reached that point? What happens when you have a company like Apple that started at 11 cents and grew over 130,000% to be at $170 a share? Is it still a good investment? Does it still have room to go up, or is it going to be stagnant and grow at 0.5% like it did over the last year? But then what about Tesla or Google or Amazon? Are these tech companies that are pushing the boundaries going to be the next leaders in digital cashless shopping, AI, or self-driving cars that no other small company can hope to do? Today, let's take a look at the 7 biggest shares in the world. We're talking about Microsoft, Apple, Alphabet, Amazon, Nvidia, Meta, and Tesla to see if these mega companies are still good investments. And I'm going to break down the numbers to see which of them I think has the best value as an investment for the future and which have the highest risk and maybe the highest reward. So let's get So hopefully all of these companies need no introduction. These are the biggest companies in the world and their brand names tend to speak for themselves. So if you've looked into investing, you've probably heard of these companies before. The only things you might not know is that Meta is the parent company of Facebook, Alphabet is the parent company for Google, and Nvidia is not as well known because it doesn't make consumer products, but they create computer infrastructure and chips for complex high-level computing, robotics, and AI, which basically supports all of the other 7 companies and allows them to do what they do. So essentially, if you were the company making bottles for Coca-Cola, you would also be doing quite well. Just that the Coke of today is computing, robotics, and AI. So now we can get right into the fun stuff, and I've taken the time to break all these companies down to the numbers and metrics, and we're going to look at the fundamental analysis information for all of them. This will show a basic idea of how we look to judge the value of a stock, and we'll be taking these metrics, putting them into a spreadsheet so that we can compare them against each other to see which of these companies is leading the others in each of the fields, and which of them might be a good investment or not. Here are the metrics we are going to be using to value these companies and compare their information against each other. We are looking at price, market cap, PE ratio, EPS, dividends, DE ratio, earnings forecast, 1-year price estimates, and historical share price growth of 1 month, 6 months, 1 year, and 5 years. And don't worry, we'll explain each of them as we go along. But before we get into it, I've just uploaded a new document to the Casual Cash Club, which is the PDF version of the book Shoe Dog by Phil Knight. It is one of my all-time favorite books, and it's the story of how Nike was founded and grown into the company it is today, written by the founder himself, Phil Knight. You might have heard how he would make the soles of his shoes with a waffle iron and then sell the shoes out of the back of his car. Well, all of that is actually quite true. So how can you not be inspired by the story of a kid selling shoes from the boot of his car that goes on to build probably the most iconic brand of our time and a current net worth of $41 billion? This channel is about helping people grow their finances or their businesses, so it's available for free to Casual Cash members, but if you want, you can use the 7-day free trial to go and get it from the link in the description. And while you're there, you can also check out all of my share purchases for the last year and my full portfolio and dividend income breakdowns. Link is in the description. And so with that, this right here is the table. Now that's a lot of data, so let's break it down. We're starting with the share name, trading symbol, and market cap. That's just information, it doesn't really tell us anything. Next, let's sort it by the PE ratio. This is the price to earnings ratio, which shows us how much we are paying per share compared to the earnings the company is making. So if Pepsi makes $100 a year and Amazon makes $100 a year, we might be more inclined to buy Amazon because there is a higher likelihood that their products can show huge growth, so we might pay $2 for Amazon shares rather than $1 for Pepsi, even if they earn the same. And that's what the PE ratio tells us, how much people are willing to pay per share for the amount of earnings a company makes. And typically, the higher the ratio, the higher people pay for the same dollar amount of earnings. But if you pay a higher price, you hope it meets those expectations. So there is also a higher element of risk if it doesn't. There was a point where Tesla had a PE ratio of over 120, but as we've seen, it didn't meet those expectations, and now the share price has fallen for a more reasonable PE ratio. So the lowest PE ratio is Meta with 25, and the highest is Nvidia with 73, meaning Meta probably has the lowest risk on share price, and Nvidia, well, it has a lot to live up to. But we'll look at that in a bit. And if you want to look through the table in more detail, all you have to do is click the like button and then pause the video. Then the earnings per share, or EPS. This very basically shows you the profitability of a company. It doesn't use share price or speculation as a metric. It simply shows us that for each share, how much profit it is making. It's probably the best metric to use to take away all the noise of the market and focus on just quite simply how profitable a company is. The higher the number, the more profitable. Here we can see that Amazon is at the bottom with $2.92 profit for each share on the stock market. Now, the number of shares in issue makes a difference, but also Amazon has been spending huge amounts on its expansion into a number of different industries like streaming, music, cashless shopping, and its web-based services. The difference is that its overall sales and revenue is huge. But on the other side here, we have Meta, or Facebook, with much lower costs since it scaled down its metaverse expenses and with negligible costs comparatively. Its latest full-year results showed a good increase in revenue, where it decreased the year before. Now let's look at dividends. Honestly, I'm not going to spend much time here because, as you can see, none of them are going to set the world on fire. The purpose of these companies is to grow quickly and remain competitive in a fast evolving tech space, and they need every cent and some debt to do that. So really, any difference here in dividends is not really worth noting, but if you are curious, they all pay less than 1% or nothing at all. Now, let's talk debt. All of these tech companies have some form of debt or liabilities, but as you can see, some are definitely more than others. Now, the DE ratio is the debt to equity ratio, and it shows how much money comes from debt versus the equity of shareholders, which is the money raised by listing on a stock exchange mostly. Now, simply, a higher debt to equity ratio means the company has more debt from banks, and usually that is bad because first it means there's a higher risk and leverage to the company, and should it fail to utilize that debt to make profits, then the company might fail to be able to pay its debts. Now, for these large companies, that's not really likely, but on the other hand, it also means that with more debt comes higher costs of capital, which means they pay more interest on their debt. But it's not always a bad thing, because if a company is paying, say, 5% interest on its debts, but it uses that debt to generate an additional 10% in profit, then it can be positive. It just means there is higher risk and higher debt costs. So Alphabet or Google is here at the bottom of that list, and Apple is way on the higher end because over the last 10 years, they have been ramping up their borrowing in a major way. Now, like we said earlier, the purpose of these shares is to increase their share price. That is the reason we buy them. So these next columns here are all about their share price and how they have performed in the past and how analysts anticipate they will perform in the future. One quick note here is that obviously all of this data changes day to day, so what this looks like now might not look the same when you want to buy, so remember to do your own research before looking to invest. First is an earnings forecast. This data is pulled from Simply Wall Street and lists how they anticipate each of the company's revenue is going to grow in the next year. And of course, revenue growth is a major indicator to share price growth. At the bottom here is Apple with a forecasted growth of just around 5%, and way on the other end is Nvidia with anticipated earnings growth per year of 23%. Then we have data from Yahoo Finance where analysts predict where each company's share price will be 1 year from now. Of course, these are just educated guesses, but it gives us some more data to use. So the difference from current share prices to the 1 year estimate is shown here, And at the bottom we have Alphabet with -3%, and at the top we have Amazon with estimated share price growth of 18%. Lastly, here we have the share price growth or decline for 1 month, 6 months, 1 year and 5 years. As you can see, the last month was lower in general for the markets, including the S&P 500, but with rocketing growth from Alphabet of 14% in just 1 month, because in their latest earnings report, it showed that recent big investments into AI are driving their growth and investors are quite excited about that future. Then Tesla is the only share with a -6 months by a big 18%, mainly due to a slowing rate of sales in the electric vehicle market in general and increased competition from overseas competitors like BYD. Yet, over 5 years, it is still in second place. But in those same 6 months, Nvidia has shown stellar growth, which we can see continuing all the way through the 1 year and 5 year, as well as an incredible 1,800% growth over 5 years. The others are roughly the same, with Apple, Microsoft and Alphabet coming in the next 3 places, and Amazon with a much lower 83% gain over 5 years, which for a larger tech company is actually not that great. In fact, with dividends, if you invested in the S&P 500, you would have gotten roughly the same return. So let's break it down. 7 of the biggest companies in the world, a table full of fundamental analysis data. What is good, what is bad, and what can we expect? Well, it comes down to risk versus reward, and if we look at the data, the highest risk and potential highest reward share here is Nvidia. It has the highest price to earnings ratio out of all of them with 73, which means people are paying the most per dollar earned for its shares. Now, Tesla's PE ratio used to be 120, and now the share price has come down to where its PE is now 43. So there is always that risk when you have a high speculative value that if they don't meet their earnings expectations or they face competition like Tesla did, then your share price could fall like Tesla's by over 50%. But at the same time, the share has also been the highest performer of the last 6 months, 1 year and 5 years, and it has a good earnings per share. The question you have to ask yourself is how much longer will it grow, and when will it hit a wall or lose momentum, and when will the market turn on it? Then we have what the numbers show as the least risky share, which is Meta or Facebook, with the lowest PE ratio of 25, which is good, as well as the highest earnings per share, which is also good, one of the 3 lowest debt to equity percentages, and one of the highest 1-year target forecasts by analysts, and a good earnings forecast. The 6-month, 1-year and 5-year growth hasn't been stellar like Nvidia, but I personally wouldn't complain with 85% growth in 1 year. Apple, Alphabet and Microsoft are all quite stable and together give some solid fundamentals to where there doesn't appear to be much risk. We never know what will happen in the markets, but they seem to be good solid options and likely to show good growth. With Amazon, there are some very interesting things happening in the company, and we'll do a full video on them soon. So if you want to see a full breakdown of Amazon, you can subscribe to the channel. And lastly, we have to talk about Tesla, but we have to talk about it a bit differently than before. I think Tesla is a cool company, but as a share, I never liked it because it was horrendously overvalued. And it's a good thing I didn't, because it's dropped 50% in the last 2 years. But the question has to be asked, whether these huge price drops make it a good investment at this point. Some people might say yes. Me personally, I'm not convinced yet. With an increase in competition in electric vehicles and a decrease in demand, because most people who wanted a Tesla or EV have already bought one, and it's not a hot product anymore like it was before. For now, it seems like their supply and demand have finally evened out and their product is saturated. I don't think it's gone as low as it can yet, but I'll keep an eye on it for the future. But I could be wrong and it could shoot up tomorrow. You never know with Tesla because it's a very volatile share. But guys, that is it for today's video. I hope you enjoyed breaking down the 7 biggest companies in the world and looking at the fundamentals to get some information on whether they would be a good investment. Please remember to like the video and subscribe to the channel if you want to see more. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.